Again, the problem is interest rates have risen, which means that the numbers have changed. Your NOI may have increased, but because debt service payments had also increased because of higher interest rates, that means the banks are going to allow the sponsors to borrow less money. And that's happening very frequently. So if you're borrowing less money, you need some extra money to make up the difference. And that's where a capital call comes in.
Welcome, everybody, to a new episode. Get ready to unravel the mysteries behind capital calls, where every decision counts and calls carry weight. Join us as we unravel the mysteries, explore the risks, and seize opportunities lurking in the dynamic world of capital calls. So strap in and get ready for a thrilling ride as we navigate the highs, the lows, and really everything in between on the exhilarating journey through the heart of real estate finance. Today, we're joined by Ravi Gupta, co-founder and COO of Viking Capital. Welcome, Ravi.
Thanks, Nathan. I've never been so excited to talk about capital calls after that introduction.
We're going to dive into it. So, can you describe what a capital call is and kind of what its meaning and purpose is in the context of multifamily syndications?
Yeah, absolutely. So capital calls has achieved a lot of notoriety of late, and it's sort of the four-letter word of investing, right? So what that means is that you've invested in a particular asset, and let's keep this focused on multifamily investments, but you can really extrapolate to any type of syndication or similar structure investment. So you invest in something, and whatever you have invested in is in need of capital for a myriad of reasons. It could be debt restructuring. It could be that the sponsor ran out of capital for CapEx. It could be that they were not managing the property correctly, or maybe didn't project correctly and need more capital. They needed more capital than they thought they did. So it could be for a myriad of reasons, but the sponsor typically will reach out to investors and ask them to invest more money into the asset. And that is what we call a capital call. And you as the investor have to decide whether you want to invest more or not into that particular asset.
Great. Yeah, and we'll dive in kind of when it makes sense to deploy more capital, when it might not make sense to kind of hold back. But there's kind of two different phases of capital calls, right? You have, at least in the world of syndications, you have the traditional capital call when you acquire the property, where you're raising for closing costs and for renovations. But the capital call that we're talking about typically happens later on in the business plan, right? Maybe like a year or two down the line for some kind of unexpected reasons. And you kind of touched on those briefly, but can you kind of dive into some of the reasons why a sponsor might choose to call a capital call and what that capital could be used for?
Yeah. So initially, when you're purchasing a property, it's termed as like an equity raise, right? You are raising capital, but you are in fact raising equity for the operations of that property. So after that particular period of time, when the sponsors operate the property and they need additional equity to be injected in, that is what we're defining a capital call as. So the reasons a sponsor would actually ask investors to reinvest or pursue a capital call are: one, debt restructuring. That seems to be one of the biggest ones now. This podcast is being recorded in June of 2024. And what's happened is the interest rates have risen. A lot of these properties have been purchased with using variable rate debt, and often they have a rate cap insurance on top of that to prevent the debt service payments to be very high. And what's happening a lot is that the term is up, and either they need to refinance or they need to pay another year of rate cap insurance, or whatever it may be. There's a need for capital to be injected. The issue with rate cap insurance, this is happening very frequently, is that the cost is so astronomically high for many of these properties, and we're experiencing that ourselves. It's not something we underwrote. When we purchased these properties several years ago, the ones that we have variable rate debt on, we were paying like $100,000 to $200,000 max for rate cap insurance, because everybody was projecting, even like the most seasoned rate cap providers out there were projecting a slow, steady rise in interest rates, not as rapid as we've seen it. Nobody was really projecting this to happen. It's unparalleled in what's happened historically. So that's how much we allocated for any additional expenses. But now a rate cap that maybe cost $200,000 several years ago now is $1.5 million or maybe even $2 million. So the price is astronomically high, and they don't have the money to put towards the rate cap. So that's the big reason you're going to see a capital call. Another reason is many sponsors want to get out of variable rate debt. So they are going into maybe long-term debt or some other debt restructure program. Again, the problem is interest rates have risen, which means that the numbers have changed. Your NOI may have increased, but because debt service payments have also increased because of higher interest rates, that means the banks are going to allow the sponsors to borrow less money. That's happening very frequently. So if you're borrowing less money, you need some extra money to make up the difference, and that's where a capital call comes in. So that's another big reason for a capital call. A third reason may be that the business plan has been complete, but sponsor finds that, hey, we need more money because we actually didn't allocate enough, or maybe the dynamics of the economy have changed such that you need to improve the units even more. So they could ask for a capital call there. And then finally, a capital call is often requested when property is going down. And this is the scary part, because this happens not infrequently. The property is going down and the sponsor doesn't know what to do. They just need more money. So they're going to ask the investors to add additional capital. Now, the problem with that scenario is that the sponsors may not have a plan to get you out. So say they ask for additional capital to just keep the property moving. Well, say it goes on for another few months and then it tanks. Then you've lost not only your principal investment, but you've also lost the additional capital you put in.
Yep. No, those are really good points. Thanks, Ravi. So, and I think we're seeing that a lot, especially in the industry right now, right? Where we had unprecedented rent growth, and even in some instances where we had just purely organic rent growth, where you didn't need to do the renovations, right? So you're getting these decent lease trade outs and units were renting for, and they previously were without having to do the renovations. And then you saw, again, to your point, the increase in debt service. We had really kind of foreseen that happening, especially when we're looking at kind of the forward-looking SOFR curves. And for those of you who don't know what that is, that's pretty much what bridge debt was based off of or is based off of. And all the forward-looking projections look to have a stark pretty decrease in that rate kind of in the next year or two. And every time we kind of checked back in with these forward-looking curves, they kept kind of re-forecasting longer and longer these hikes in interest rates. And so what you saw some sponsors do is that they're getting decent organic rent growth and decide to say, hey, we don't need to do the renovations. Why don't we kind of reallocate the capital, maybe put it towards debt service, maybe put it towards a distribution reserve for whatever reason. And now they're in a pickle where they're not getting the same organic rent growth that they did, but now they need to have excess capital for those renovations, but don't have that capital available, right? And so that's kind of when you get to these capital calls where it's not always a great situation, but there is kind of some silver lining where if there's a viable business plan to say, hey, there's capital that's going to be injected and it's going to go towards renovation, or it's going to go towards these rate caps to help kind of mitigate the issues that we're currently facing, there are some properties that definitely can kind of turn themselves around. But as everything, there's always a continuum, right? So there's going to be properties that can't turn themselves around and will have to do capital calls and may not be able to get out of it. So what can kind of investors expect when, they get this notice for a capital call? What's kind of the traditional structure? What's the kind of typical messaging? And then kind of what questions should they be asking of the sponsor for kind of the future growth of the business plan?
Yeah, and that's a great question, Nathan, because when you do get a notice for a capital call, and I've gotten notices for capital calls, I've invested not only with Viking, but with several other sponsors. And recently I got a notice and it was concerning to me at first. And just to be honest, I was like, oh God, like invest for more money and they've stopped just distributions and what's going on here. And the part of me that's more emotional was thinking, okay, my entire investment's lost. It's just the way it is. And let me just not pay the capital call and move on. And I would say probably many people think that way. They're just, when they see that message come across their screen or the email or the call or whatever it may be, they automatically think the worst. And I would just advise whoever is getting that notice not to do that, because it's an emotional reaction. But if you look at it from another call, can be in fact a good thing. By that, I mean that if the sponsor has a business plan and has a good way to come out of the hole they're in with the capital that you inject into that property or that asset, then it's good because it'll preserve your original investment. And in fact, you may end up making money afterwards. I spoke with a sponsor recently who was in a situation. Now, this was the last market cycle, but they were in a situation where they needed capital. And some investments were like, look, I'm not going to invest any. I'm done with this. But some supported the project. They knew how eventually it would turn around, and they actually added more capital than they necessarily needed to, and they got out very well. So the people that originally invested actually made money, but the people that put that money towards the capital call, in fact, made a lot more money. So situations like that can happen. So when you get a notice for a capital call, one, I would say don't get emotional about it. In fact, your first call should not be to the sponsor and chewing them out. What is going on here? Why am I getting this message? What did you do? You screwed up my investment. It's the worst investment. That happens. And you kind of think that. But I would say take some deep breaths and think about what's happening here. Number one, do you trust this sponsor? Do you think that they are good stewards of your invested capital? Number two, did they come up with a solid business plan to take your capital and improve the asset so that when they exit, it's going to actually make money or at least get your money back? And number three, when is that return of capital coming back to you? The new capital that you invested. Perhaps it'll come back sooner than the original capital you invested. So that's something to think about. So you really have to just kind of high level, and we could probably get into more details in this conversation, but high level, just look to see what they're going to use the capital for and get all the data before you make a decision. And remember, you can choose to participate or not. This doesn't mean that you have to participate. It's not like they're going to sue you if you don't. It's your choice whether you want to or not.
Yep. It's a really good point. For me, it's always kind of thinking like, how did they get themselves in a situation? What happened in the past that kind of led to the capital call? What kind of other alternatives have they tried, right? Have they tried supplemental loans or pref equity, or they tried to stop the hemorrhaging of expenses or whatever it is, right? And then kind of what is that capital going to be used for? If you can find answers to all three of those, is to, hey, how do we get to the situation we are? What alternatives have we explored? And what kind of solutions does this capital provide? I think if you have solid answers and you trust a sponsor, that can lead to some really, to your point, some really kind of fruitful investment opportunities, because the alternative is a pretty bleak situation, right? Ultimately, you don't want to have to do a capital call, but when you get to the capital call stage, there's a reason that you're calling kind of more capital from the investors, and the investors should understand how that affects the capital stack, right? Because now, if you inject more equity, the pref return goes up and your profit splits might change, right? And so to reforecast, hey, once we inject this capital, what's it going to be used for, and kind of how does that reforecast our investment thesis? I think is a really important question to answer on these capital calls, because ultimately that's what investors care about, right? Is my capital protected, or am I going to lose my investment, to your point?
Yeah, absolutely. So all those questions that you actually relay to us are very important. In fact, those are the fundamental questions you should ask, and you should get all the information. And then you should also ask what the prospect is of them raising the full amount of capital. Because if they're telling you, yeah, like we've got a lot of investors very interested, we're going to raise a full amount, that's a positive sign. That means that things are going to happen. And maybe you choose not to participate then because you're like, okay, well, they're going to raise the full amount, so maybe I don't need to. But if you're in a situation where the sponsor says, look, you have an option, you don't have to invest with us, and many people seem like they're not. And if you don't, we're going to sell. And if we sell now, you're only going to get maybe like 25% of your capital back. Or maybe you get none of your capital, your original invested capital back. That's a tough pill to swallow too. So in that situation, you may be forced to do it. You may have to say, look, I don't do it. If the whole LP group that has invested in this project does not add to it, then we're going to lose everything. And that's something to consider too. So you got to look at options, look at what's going to happen if you invest, look at what happens if you don't invest.
Yep. Yeah, brilliant. What would cause somebody to choose to invest or to choose to hold back? Is it just personal preference, or are there kind of other factors at play?
Well, there's always the personal financial issues going on with that and any given individual. If you're in a situation where you just don't have the capital, you obviously can't do it. And there are business-related decisions to be made. So number one, I mentioned this before, do you trust the sponsor? That's a fundamental question to ask yourself. Has this person performed in the past? Historically, have they been good stewards of invested capital? There are many syndicators that I know that are relatively new out there, and they're in a situation where they have to request capital. I'm not saying don't invest with them, but I'm saying that may be a sponsor that you may want to think twice about, because you don't want to be in a situation where you're going to lose your entire investment plus the money that has been put towards the capital call. So number one, I determine if you trust them, look at their past history. Number two, look at their business plan, talk to the investor relations team, see what they're going to do with that capital, ask them what their plan is to right size any of the assets they have in the fund that you're invested in, or whatever. If it's a particular asset, that particular asset, see what their plan is. And number three, find out when you're going to get that capital back. And I'll use the sponsor that I just mentioned previously as an example. They originally asked for the capital call. They put together an email and a presentation, a webinar that described exactly what they were going to do with the money. They also stated that it was a fund that I invested in. So they stated that they're going to sell an asset in the fund next year, that the one that was performing well, the one of the 8 that's performing well. And the people that put money in would be the first to get their money back after that sale. And then the other thing that they mentioned is if you do not participate, your original investment is diluted. And sometimes that does happen. So your 100,000 that you invested may be worth only 85 if they project a 1x equity multiple on the deal. And in this particular instance, they said, well, your original investment is diluted if you don't participate, but if you participate, it is not diluted. So that's another incentive for people to say, okay, well, I'm going to put in that extra cash into this investment to right size it.
Yeah, absolutely. Can you talk a little bit, about, it's always, important to be proactive rather than reactive, right? That's kind of the secret of success is to kind of get ahead of problems before they're kind of at your doorstep. Can you talk a little bit about how Viking has, shifted its strategy in terms of the recent kind of market that we've seen and as it relates to capital calls, and I'll kind of chime in at the end how we've also kind of adjusted our underwriting support what you're going to say.
Yeah, absolutely. Many of us who have continued to transact in the period of 2021, 2022 are in a similar situation, including Viking. There's several loans that we have that are variable rate. We have cap rates that we have to purchase that in order to extend the loans, and the cost is much more than we anticipated. So number one, we want to prevent any losses of your principal investment. So that's our primary motive and intent, is that you do not lose any money. Right? That should always be there. But number two, we also have to protect the property itself, because if we start distributing cash that we don't necessarily have, the property is going to go down, maintenance is down, your investment will just be lost. So in that case, we look at how much cash reserves we have, and we had made a difficult decision to stop distributions on several of these properties because we just could not support the distributions and the property at the same time. And we also needed the cash to continue to pay maybe the higher mortgage or maybe save up for the rate cap insurance. And then number three, we always are conservative in how we put together our deals, and we always try to raise additional capital in the event something untoward happens. And this was an untoward situation. And luckily we had extra capital for several of these projects where we were able to pay the rate cap insurance without asking for additional money from investors. That's how we functioned on a few properties. Another one where the loan was coming due, we're able to refinance into a CMBS product. So there's agency products, Fannie, Freddie, HUD, and then there's CMBS and alternative types of debt. So we use a CMBS product and we're able to get better leverage in that particular product than we were with agency debt. So that way we were able to avoid a capital call. And then finally, we also have an equity fund, which invests not really in Viking assets, but various other assets. And we're looking for all different types of investments, and particularly investments where sponsors that are really good sponsors and where the properties are really well need an additional injection of equity, and we're there to help. So it's called a hero fund, and we use some of those funds for our own projects to actually help bolster them. And that way we avoided a capital call. And the projects were doing so well with that injected capital that we were able to give additional returns to the hero fund, which is an equity fund. And if you're interested in that pref equity structure, obviously look it up. Just Google what pref equity means or look at our previous podcast. But then you can check out the hero fund too.
Yep, absolutely. And then side on that, Robbie, from an underwriting perspective, we also got a lot more, I'd say, nuance in how we're underwriting deals. We were very kind of diligent in how we were tracking expenses and debt. But really kind of with the recent cycle we saw with rents going in a lot of markets with negative rent growth, debt going through the roof, you want to kind of, again, to your point, adjust and kind of get proactive in how we're underwriting deals. So from a debt perspective, we're looking at really kind of transitioning more towards fixed debt. We kind of saw the benefits that Bridget had, but then also the drawbacks it had. And if we want the flexibility that fixed rate debt kind of offers without having the rate cap issues and kind of the other funny issues that we've seen on the budget side of things. And also now working with a lender who really we feel advocates for our needs, is really great at negotiating terms and conditions that are in our favor. They really help kind of set the stage for if these issues are to arise kind of further down the road, we already have a plan in place and the legal kind of backing to just kind of move quickly. Secondly, we've also kind of taken a look at rent growth in a lot of markets, and given kind of the rent growth that we've seen, we've been a lot more conservative on the revenue side of things. On the expense side of things too, a lot of the underwriting for deals don't pass our muster because we have to raise rents to what we're seeing actually on site rather than just kind of theoretical rules of thumb. And when we raise a lot of these expenses to what we think our property management team can work off of a healthy budget, a lot of deals don't pencil anymore. And so from a debt perspective, from a revenue perspective, and from an expense perspective, we're trying to get more conservative. We've also got a new kind of reserve where it's almost a repair reserve. So there's just more contingencies, right? The more contingencies you have, the more reserves you have, the better off you're going to be further down the line when you are in a cash crunch. So, Ravi, as we kind of wrap up the episode, what are some common pitfalls or challenges that investors or syndicators may encounter when they're going through their first capital call?
Yeah, absolutely. And I just want to stack on what you said first, because what you said is vitally important. We've learned, many of us that have invested throughout this past economic cycle have learned from what works and what doesn't. And to your point, we're adjusting our projections, we're adjusting how we underwrite and how we do business. And what we're seeing now is almost, and I've heard this from other people, but it'll be almost like a generational type experience, just like we had previously where you had the super low interest rates. We haven't seen that in, I don't think we've ever seen anything that low. But now we're getting to the point where because these sponsors are struggling and also sponsors have to transact because their loan terms are coming due or for a myriad of reasons, we're seeing these properties come up with a very low cost basis. And that's actually potentially a generational type event where we can actually acquire these properties at a very low cost basis. So there's like a benefit there, right? So there's something called dollar cost averaging here. You invested in something that may have been high cost, maybe that there's a capital call, but if you continue to invest, you're investing now in something that's a low cost basis, and it'll sort of even out. So I just want to throw that out there. So the challenges the syndicators would have first-time capital call are number one, the participation rate. Whether they can adequately get their investors to participate is vitally important for it to be successful. Number two, if they communicate effectively. Have they previously communicated that everything's going well, then all of a sudden a capital call is required? That's going to really piss off a lot of people. So number two, that may be a pitfall, is that their communication was poor. So they have to reset expectations that way. Number three is actually planning enough time to raise that capital, because if you are in need of that capital in like a couple months and you just start a capital call campaign, you may be in trouble. So those are some of the common pitfalls that the sponsors may run into when trying for a capital call. And then the final one to think about is, as I mentioned previously, is experience in the space. So if someone's lacking in experience, it's just another way that potentially things could go wrong if they don't know how to do this properly. They've never done one before, or maybe they're a new sponsor. So that's another thing another way that things could go wrong.
Yep. Yeah, absolutely. And from an investor's perspective, it really comes down to trust with a sponsor, their ability to fund, right? Those two are going to be paramount, right? Do you have the capital to invest, right? That's pretty much going to change the decision, right? Whether you can or can't invest. And then two, do you trust a sponsor to fulfill the future business plan? And if both things are yes, then I'd say move forward with the capital call. If there's a no on either front, then it's time for discussions with the IR team or with the sponsor directly. We've covered a lot today with capital calls. I know it's not a super fun topic necessarily to talk about, but I think it's an important one, right? Especially for investors to really understand kind of what expectations are to come for down the line, and for sponsors to really kind of get proactive in their messaging and in their relationship building with the investors as well. So, any last kind of golden nuggets or words of wisdom before we sign off?
I think this is a very timely discussion. I mean, every investor that I speak with that has invested in multiple properties is experiencing something like this with a sponsor. And I'm really proud to say that Viking hasn't had a capital call. I can't say that we'll never have one, because you never know, but we have really tried to button up things as tight as we can so that we prevent them from happening, because we know how difficult it is for an investor to experience that. But that's just something else to ask sponsors that you're investing in. Have you had a capital call? It's not necessarily a bad thing if they have, but how did it go? What did you actually turn the property around? Because if they tell you, yes, we had one and we're actually turning around and it's looking great, then hey, that's actually a good thing, because they've experienced the bad, they've corrected it, and they've changed how they operated. And I don't know if you've heard of a hormetic stress, Nathan, before, but hormesis is basically what doesn't kill you, makes you stronger. We use it a lot in medicine, but it's true in anything, like in real estate, right? Like you go through a lot of shit sometimes, and you try your best to maneuver and make the best of it. And if you come out, when you come out as a stronger person or a strong company for it.
Yep, absolutely. Yeah. I would say you don't want a knight in shining armor, right? You want a knight that is marred by sweat, blood, and by the battle. That's how you get truly tested good operators that can perform when the seas are calm, but also when the seas are rough, and you got to kind of be nimble and adjust to the sails. So really appreciate it, Robbie. This is a great conversation. I know it'll be a lot of important messages and important nuggets for a lot of investors out there. So feel free to type in any other questions, and we'll see you on the next episode. Thanks, everybody.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.